Welcome back to Macro Blueprint. Today, we are looking past the abstractions of global finance to examine the physical infrastructure required to move data at the speed of light. We often talk about the modern stock market as a frictionless digital cloud. It is a comforting myth, a virtual arena where success is determined solely by the logic of the smartest algorithms. But the reality of the market is far more industrial. Competing in the digital space requires a physical war over geography, often involving massive, landscape-altering construction projects. In 2009, a group of investors began violently tearing through the Allegheny Mountains. They were spending $300 million to dig an 825-mile trench, a perfectly straight line of fiber-optic cable running from New Jersey to Chicago. The project existed to solve a single problem: existing routes were too slow. By straightening the path, these investors could shave 3 milliseconds off data transit times. In high-frequency trading, those 3 one-thousandths of a second were worth a $300 million price tag. The venture was called Spread Networks. It was led by trader Dan Spivey and Jim Barksdale, the former CEO of Netscape, who provided the capital and the technological credibility needed to build a private network in total secrecy. Before this project, trade data followed the path of least resistance. Fiber optic lines were laid alongside legacy railroad tracks, following the winding 19th century curves of the American landscape. Spread networks ignored those established paths. They used rock saws and dynamite to cut a straight line through mountains and under rivers, prioritizing the shortest geographic distance over the ease of construction. For these traders, gaining an edge in the market had evolved from a software problem into a heavy machinery problem. To understand why a straight line is worth hundreds of millions of dollars, we have to look at a strategy called geographic arbitrage. If a stock's price changes at an exchange in New York, that information must travel to the futures market in Chicago. If your firm receives that update even a millisecond before the rest of the market, you can execute a trade in Chicago based on information that hasn't arrived yet. It is effectively a risk-free profit. Spread's direct route brought the round-trip latency between these hubs down to 13.3 milliseconds. On this map, that straight line represents the fastest possible speed through a glass cable. The business model was as exclusive as the route. Spread limited access to 200 clients, each paying roughly $14 million upfront for the privilege of using the line. While $14 million is a significant barrier to entry, the industry was generating an estimated $20 billion in annual profit from these price discrepancies. For the biggest firms, the cost of the tunnel was a minor overhead expense. Spread Networks had successfully turned physical geography into a private toll booth on time. But the ultimate value of a $300 million hole in the ground is entirely dependent on the unyielding laws of physics. There is a physical limit to how fast data can travel through fiber. Because light has to bounce off the walls of the glass core, it only moves at about 70 trip, making the fiber tunnel the slow route. The engineering marvel that Spivey and Barksdale built was defeated not by better code, but by the simple fact that light moves much faster through the open sky than it does through a cable. The industry exodus was nearly instantaneous. As soon as the microwave networks went live, traders abandoned the fiber tunnel for the faster air-based alternative. The financial impact followed the speed. In 2017, Spread Networks was sold for $127 million, a recovery of less than half its original construction cost. In this specific geographic arms race, the value of the infrastructure is tied entirely to its status as the fastest path. The moment that edge is lost to a faster medium, the premium the owner can charge begins to evaporate. The fate of Spread Networks highlights a broader tension within the foundations of the global financial system. Modern markets are built on the regulatory assumption that information is public. The theory is that once a company releases data, every investor has an equal opportunity to react to it. But by spending millions to shave milliseconds off transmission, firms are effectively privatizing that public information. They aren't finding new data, they are simply seeing the public data sooner than anyone else. In the narrow world of high-speed arbitrage, the traditional metrics of company value are often secondary. Success is determined by which server is physically closer to the source. It leaves us with a difficult question: how public is market information when the speed of light itself has become a proprietary asset?